Okay, let's get started. Hi, everyone. Thanks for joining us for today's webinar. My name is Stephen Reiter. I'm responsible for the options business at AvaTrade. In front of you on the screen, you see the login screen for our options platform. And I'm going to log in with this demo account that I've created. You can log in from avatrade.com and just click on web trading next to your Ava options account. If you don't have one, please create one. So today we're going to be talking about delta hedging. And to talk about delta hedging, the first question, of course, is going to be, what's delta? So let's get right into it. And I'm going to do the best I can to answer all questions along the way, so please feel free to type them in. I'm being asked if there's a demo account for options. To create a demo account, you simply need to log in to avatrade.com and choose to open a demo account. If you already have an account with AvaTrade, at the registration, at your My Accounts page at the top right, you'll see a button that says Add Account. So make sure to choose to add a demo account and then choose Ava Options. You can add demo accounts if you're already a registered customer. We absolutely have demo accounts. You also can open demo accounts from the mobile app. So this is our trading platform, and this is our web-based trading platform, also called the Web Trader. And let me find the presentation tools here. Let me see if I can figure out how to do this. Sharing. Just give me 1 second. I know that there's tools for sharing the screen. Let's see. Options, view. Well, there's some way for me to annotate the screen, and I'm trying to figure out how to do it, but I don't know how. So I'll just go ahead without it. Wait a minute. No, that doesn't help me. Okay. So this is our trading platform. What you see here looks like many other trading platforms. On the left side of the screen, you have all the different assets that can be traded. We have categories if you want to narrow it down just to look, for example, at the FX majors, or you can define your own favorites by choosing them with this star. Anything starred is going to appear in your favorites listing. So here are my favorites, or I can go back to all. You can see here various products. You've got currencies, you have some equity indices, gold and silver, and crude for crude oil. When you click on the bid or ask of any asset, you're going to get a chart. So let's look at the pound, for example. This is the pound against the dollar. This is a spot trade. Spot trade meaning we're just buying the foreign exchange rate. We're going to buy the pound. The size is set at 100,000. The right side of the screen is what's unique. The right side of the screen, we have a profit and loss diagram. We can see our profit. If the market is going higher, you can make unlimited profits. If the market goes lower, you're exposed to unlimited loss potential. I can see my P&L in dollars, I can see it in pounds, or I can see it expressed in price, just like the asset itself. So I'm going to choose dollars. If I increase the size of my trade, then of course I'm going to see an increase in the profit and loss of the trade as a larger trade. Let's put it back to 100,000. If the market goes up from 139.60 to 130 to around 139.70, that's 10 pips on 100,000. You're going to make $100, which you see right here. If I click the limit button, I can put a take profit. So for example, market's now at 139, almost 139.60. If I double click and I put in a take profit at 139.70, that's about 13 pips higher. You can see your profit, or 12 pips higher, your profit's going to be $120. 12 pips, $120 on 100,000. If we make the trade larger, then of course your P&L will be higher. So that's how you put in a take profit. Again, we're not talking about options yet. This is just trading spot, I can also put in a stop loss. If I double click, I can make my stop loss good till canceled, good until the end of this week, or good until the end of the day. Very simple. So the profit and loss diagram then shows you you'll be profiting until we get to the take profit, or you may be losing money until you hit the stop loss. The colors give you a clear indication of what's going on. Once you are past your stop loss, you're out of the trade, so all the bars go gray. And once you're past your take profit, all the bars go gray. Why do we have this kind of a P&L diagram? Because we want to talk about options. Instead of trading spot right up here, I can click this strategy button and choose an option or an option strategy. So we're going to keep it simple. Let's just focus on a call option for now. A call option gives a user the right, the buyer of the option has the right to buy an asset at a specific price on a specific date. A call option in this case, we're looking at an option on the pound against the dollar. The strike is set here. It's a 139.50 call. The expiration date is up at the top. You see expiration date, 6th of May, 2021 at 2 in the afternoon GMT, which is a 7-day option. That option is going to cost 0.00598 or 60 pips. You can see that in the white text above the strike line. You can see it in the buy and sell buttons. If I click this white box in the middle instead of price, I can see the cost in dollars or in pounds. Actually, no, just dollars it's showing me. So I can buy this option. It'll cost me $596, which is 59.3 pips or 0.00593. On the right side, our profit and loss diagram now is asymmetric. When you buy an option, the most you can lose is what you paid for the option. That's why in red, you see the cost of the option is the most you could lose. But in green, you can see you have unlimited profit potential. In the center, you have a new element on the screen, which is called the confidence range. These two white dots at the top and the bottom are showing you 2 standard deviations of movement over 7 days. Basically, we're trying to frame the risk of the trade. The implied volatility of the option tells us how much the market expects, how volatile the market expects the asset, which is the pound against the dollar, to be. So this implied volatility of 6.69% is telling us how much we think the market can move. Between these 2 white dots, that's plus and minus 2 standard deviations, we can be 95% confident that the market is going to be between those 2 dots in 1 week at expiration. The red and green line shows you your profit and loss expiration, and the orange line is showing you your P&L today. So this is where we get into delta. Today we're buying this option and we see that it costs $591 or 0.0059. Your profit and loss today is, if you buy this option now and sell it immediately, you're only going to be losing the bid-ask spread. So you have a small loss at the open right now. You have a small realized loss. If I click buy again, you get the execution window. You can see the bid-ask spread is about $79. If you buy this option right now and sell it immediately, you'll lose $79, which is about 8 pips. If the market starts to move higher, you're going to start to make money. But you see that you're not moving this orange line. Your profit is not 1 for 1 with the spot rate. It's not 1 for 1. The slope of this line is not 45 degrees. The slope of this line is about half of that. So the delta on this option, you see in the middle, D equals 0.0052, that's the delta. The delta is telling us for every 10 pips that the pound moves higher, the option is going to move about 5 pips higher. The option profitability at this exact moment in time is going to be about 50% of the change in the underlying at this moment in time instantaneously. That means if the pound goes from 139.55 to 139.65, the option is going to go from 59 pips to 64 pips. And you can see that right on this orange line. If the market is going down, same story. as the market goes down, if spot drops 10 pips, the option value will drop about 5 pips. That's the delta. The delta is the change in the option price relative to the change in the underlying asset. Now, I assume you can all hear me, so feel free to ask questions. It's okay. I speak a little bit quickly because I've been doing this for a while. The slope of the line at today is about 50%, but if you look up when the market's much higher, the slope of the line is going to get to 100%. Up here at higher levels of the pound, when the option is deep in the money, for every 10 pips that the pound moves higher, the option will also move up 10 pips. There, the delta is 100%, or 1.00. And down at the bottom of our screen, the most the option can lose is what it costs. You cannot lose more than 59 pips. If you pay 59 pips for the option and the market moves lower, in 1 week, your option will be worth 0. It doesn't matter how much lower it goes because you cannot lose any more. And that's why down near the bottom, you see your delta is close to 0, because once the option is worthless, it can't get any worse. It's still worthless. So the delta of the option of a call option moves from 0 when it's way out of the money to 50% when it's at the money or at the money forward to 100% when it's deep in the money. At expiration, on the very last moment of the option's life, there are only 2 choices. The delta is either 0, where it's out of the money, where spot is below the strike, or it's 100% when spot is above the strike. And we can see how the delta evolves over the life of the option. Today, we see the delta is around 50%. If I use this horizon line right here, I can see how the P&L or the value of the option changes over time. At expiration, the delta is either 0 or 1. As you get close to expiration, the P&L or the value of this option approaches the terminal value, the intrinsic value of the option. Now I'm showing you here an option that's at the money. The market's trading around 139.50 and the call strike is 139.50, which means the buyer of this option has the right to buy at 139.50. The delta is about 50% because standing right here today, we're trading at 139.50. You have the right to buy at 139.50. The market's either going to go higher or it's going to go lower. Right? The current price of the pound in the market is 139.50. Either we're going to go higher or lower. All the information is in that price of 139.55, so it's a 50-50 chance. So the delta is about 50%. I can use my mouse and grab this call button on the right side of the screen and change it and change the strike of the option. So let's say I move this strike up to 140.50, 1.405. I've moved the strike of the option higher, which means I have the right to buy the pound against the dollar at 1.405. So instead of buying it at 139.50, I have the right to buy it at 140.50, 1 point higher. This option is called out of the money. Because the option has a lower chance of having a profit, it has a lower chance of finishing in the money, its delta is lower. This option has pretty much a 23% chance of finishing in the money. That's what the delta is telling us. It's not perfect, but it's pretty close. If the delta is 23%, that means that there's a 23% probability, according to the market valuations, there's a 23% probability that the pound is going to be higher than 140.50, 1.405 at expiration. Today, right here at the spot line at 139.50, the delta of the option is about 23%. That means that if spot moves higher by 10 pips, the option value is going to go up by about 2.5 pips. And as the market continues to go higher, you see the convexity of this orange line. As the market continues to go higher, the delta is going to get higher, again approaching 1. So that delta is telling us how much we expect, how much the option price is going to change as spot changes. If I move my strike much lower, I have the right here, I have the right to buy at 138 when the market's already trading at 139.50, this option is already in the money. So there's a very high chance it's going to stay in the money. In fact, there's an 87% probability that the market's going to finish above that strike. So the delta on this option is already pretty close to 1. It's already 87% because there's only a week to go. The market's well above the strike. That's what the delta is telling us. Now let's put on this trade. Actually, first I want to clear out an existing position. Down at the bottom, you see I have an existing position. Earlier in open positions, I had bought Eurodollar, 100,000 Eurodollar at 121.31. I'm going to close that position. To close it, I just select it with that checkbox. It pops into my open positions window, and you can see where I bought it. And I can see that I have an unrealized loss on this trade of about $50. I'm going to close this trade, just click execute, and that's done. And you'll see it's going to disappear from the open positions in a moment. It's going to disappear from open positions in a moment. And hello, make sure that I closed it successfully. Yep, I did. We have some kind of a delay there. In open positions, it did not get updated. There it is. Open positions, now you see the position is gone. There's a delay that we'll investigate. So I have no positions right now. I have an account value of $99,950. I had lost $50 on that trade. Let's do an option trade. I'm going to use the example we used before, which was the pound against the dollar. I'm going to trade a call. I'm going to buy 100,000, and I'm going to change my expiration date to 1 month. I'm going to buy a 1 month option struck at 139.50. The delta is 51%. I click buy. I don't need any margin because I'm buying an option. Buying options does not require margin. You just pay cash. It's yours, and you're finished. I click execute. And the trade is done. I bought a call, and it's going to show up in our open positions. There it is. We bought a call on the pound at 139.50. I have an unrealized loss simply because of the bid-ask spread that we mentioned earlier. This is my position, the only position that I have. If I click it, just like I showed you before, it's going to populate into my screen like that. So here we can see the position. Let's just get our history more relevant. So we can see what the P&L of this option looks like. Wait a sec. This needs to update. We're zoomed in too far. I'm not sure why. Just 1 sec. Okay. That's showing me a 1 minute history. There we go. So this is the position that we have. We bought a call. I can't change it. We're looking at the existing open position. And you see that the delta is still about 50%. Down at the bottom, the total delta says 50,900, which is 50% of the notional value of 100,000. If I click on the risk manager, I can see that another way. Because we are long effectively 50,000 of the pound against the dollar, it means we're long the pound and short the dollar. There it is. So here you can see all of our risk. We're long the pound and short the dollar, and it's coming from options. This is our risk management system. You can see total delta by currency pair. Our only position is in the pound, and we are long $70,000 worth of the pound against the dollar. Total delta, again, 50,000 pounds. If you go by currency pair, it'll show it to you in your account currency, which is dollars. So that's our position. The delta is about 50,000. And suppose we want to neutralize our account value against changes in the pound against the dollar. Right now, we have a positive delta. A positive delta means, as we said, if the market moves higher, we're going to make money. If the market goes lower, we're going to lose money. The orange line is positively sloped. The market goes up, we win. If the market goes down, we lose in different amounts over time because we bought an option. Delta hedging means that we're going to overlay this position with a spot trade so that we are not biased against the market moving higher or lower. We're going to neutralize our risk. So if our current position is equivalent to being long 50,000 of pound against the dollar, to delta hedge, we're going to sell 50,000 pounds. If we sell 50,000 pounds, our delta, our net delta, is going to go to 0. Let's test it. I click on the pound. I'm going to do a spot trade. I'm going to sell 50,000. When I sell 50,000, right, it's going to reduce our risk. I click execute. That's done. And our risk is going to change. As you see, it has already. The trade is in the positions. There we go. We bought an option on 100,000. We sold 50,000 cash. So we are long 50,000 delta in the option, short 50,000 in cash. If I go over here into my risk manager, you see the same thing. Our net delta from the pound against the dollar is only 900 pounds, 800 pounds, very small. It's coming from being short the underlying, short the pound, and long an option. And if we look at our positions together in the risk manager, here's our call. Just close this. There's the call. And let's also see the cash position. And you see what we have now. We now have neutralized our risk in that the slope of the orange line is now 0. We're going to make money as the market moves higher. We're going to make money as the market goes lower because we're long an option. But as we profit from the option, as the market moves higher, we're going to lose on the spot trade at the very local area. So we're very flat at the local area at the current price. If the market goes up or down 10 or 20 pips, there's not going to be much change in my P&L. Eventually, if the market moves much higher, the delta of the option is going to go to 100% or 100,000 pounds. We'll still be short 50,000 pounds, so our delta will get up to 50,000. And on the downside, the option delta will go to 0, but we'll still be short 50,000 pounds. So we're going to be short 50,000 pounds. So we're going to profit if the market moves much higher. We're going to profit if the market moves much lower. So we've converted our position from this to this. Or looking at it another way, this was our spot position. This is our option position. Sorry. This is our spot position. This is our option position. Put them together, and we've converted into the P&L that looks just like a straddle. It means if the market stays where it is, exactly where it is, we're going to lose our option premium because we paid, what did we pay for this option? It shows us right here. We paid $1,200 for this option. You see cost $1,200. We paid $1,200 for the option. If the market doesn't move, we're going to lose $1,200 because the market hasn't moved. We're at the money, at the strike. The option is worth 0, and we have not made or lost any money on the spot trade. However, if the market starts to go much lower, our option is not going to lose more money, but we're going to start to make lots of profit on the spot trade. And on the other hand, if the market moves higher, then the option is going to make money. The cash position is going to start losing money, but it's half the size, and together we still have profits. So that is what delta hedging is all about. Delta hedging is creating an exposure to volatility instead of an exposure to delta. We're getting rid of our exposure to the spot rate at the local price, at the local point. But as the market moves much higher, your delta is going to change, and you'll need to delta hedge again if your intention is to stay neutral to the market direction. So that's what delta hedging is all about. Delta is an important concept to understand. Again, it tells you both what is the sensitivity of your option price, or what's the sensitivity of your portfolio to a change in the underlying assets price, but it's also telling you what does the market think the probability is that the market is going to finish above your strike or below your strike. How about some questions? I can't possibly have been that clear. Here's a question. Eric, do you always sell half your position for the hedge? Well, Eric, to do a delta hedge, you need to hedge the delta. Let me do another example because that probably wasn't clear. I'm going to close both of these out because they were both highlighted. So now we have no position. Both positions are gone. You can see in our risk manager, we have no delta. Here's our history. We opened and closed. And here's our closed trades. We closed now both of those positions. We have no open positions. Let's start afresh. I'm going to do it now with the euro dollar. Suppose we buy a 1 month call on euro dollar. I'm going to set my strike though much higher. I'll put my strike at 20 delta. And by the way, I can double click here. I can specify this strike by choosing delta, and I can say, suppose I want to do a 25 delta option. Click apply. It'll choose the strike that equals a 25 delta option. So now I've got a 25 delta option. The strike is 122.67. I'm going to buy this option in 100,000. Click execute. It'll come into our positions, and you see that our net delta now is 25,000. The slope of this line at spot is only 25%. So if I want to hedge that in the risk manager, you see our delta is 25,000. To neutralize that, I need to sell 25,000. So let's do a spot trade. We're going to sell. The minimum trade size is 10,000, so I'm just going to sell 20,000. I sell 20,000, execute. That's done. It's come into our open positions right away. And if we look at our risk manager now, you see that our net delta is 5,000 because we're long 25,000 from the option, short 20,000 from spot. Let's choose them both. And now you see again, at the current market price, the slope of this orange line, the change or the sensitivity of our portfolio to the change in the underlying asset is pretty flat. However, if the market starts to move higher or lower, that will change. But it's no longer symmetric because we use an out of the money option. So if you put on a trade, if you have a view that euro dollar is going to move higher, but there's an event coming out, you think it's going to be higher in 6 months, but over the next hour, you're not so sure, and you want to put on a temporary hedge and reduce your exposure to the market, you can do delta hedging like I just showed you and remove your exposure to the market. Again, there's our call, and here's our hedge. Right, take the hedge off, it looks like that. With the hedge, looks like this. You can see both positions in the market. There's just a spot position, there's spot and options together. You can close them both, execute, and they're both closed. They'll both disappear from our open positions. There you go, we're flat again. Let's have a look at other option strategies. For example, a call spread. A call spread means you're buying one option and selling another option. If you don't know what these strategies are, by the way, you can just click here, Guide, choose the strategy, call spread, and you get a little explanation of what a call spread is. In a call spread, it's a low risk trade. You're buying one option and selling another. Click try it. You see it in green, we're buying the 120.80 call. Let's take that down to 120.50. Let's make this option a month. We're gonna buy, let's go even lower. Let's buy a 119.50 call, and let's sell a 123.50 call. So I'm buying one option and selling the other option. It's low cost because we're buying one, we have limited risk on the downside, limited risk on the upside. The most we can lose is $392. The most we can gain is about $400. So it's even. Our risk is even. And if I move my horizon line, you can see how this option evolves over time. So by buying one option that has an 84 delta and selling another option which has a 15 delta, the net delta of this trade is 70%. Let's do this in 100,000. Buy, execute, buying one option, selling the other. It's done. And you see that our net delta is going to be 70,000, roughly 70,000. There you go. Total delta is 69,000. That's our exposure. So if you want to hedge that, we can sell 70,000. So if I go and go into cash, spot, try it. If I sell 70,000, that's going to neutralize our risk. Execute, that's done. Risk manager, you see our total delta is now close to 0. If I choose all of the positions, I can click here, choose all Eurodollar positions. You'll see that the exposure has changed into this kind of wacky thing, but all we've done is we've limited our risk at the current level. We've made this pretty flat. And that was what we tried to achieve, and you can have all sorts of fun with options. Okay. This strategy doesn't make a heck of a lot of sense. The point is, I had a view for the longer term, but in the short term, I wanted to hedge it. If I take that hedge off, it looks like this. With the hedge, it looks like this. And if I had done a smaller hedge, instead of 70,000, suppose we only had 20,000. Let's just reduce this. Let's close 50,000 of this spot trade. Okay, I'm going to do a partial close of 50,000. Execute. Now our position is going to drop from 70,000 to 20,000, as you see. Let's choose all of our positions. And now you see I'm not completely hedged. I'm only partially hedged. So you see the risk has been reduced, but not completely. We still have a net delta of 50,000 instead of 70,000. So that's what delta hedging is all about. Delta hedging works for whatever your portfolio is. You could be any combination of things, long, short, calls, puts, whatever it is. Delta hedging, the idea is to neutralize your risk so that your exposure is one about volatility instead of directional. That's pretty much what I wanted to get across today. That was the purpose of today's and the subject of today's webinar. If anyone has other questions, I'll be happy to answer them. Otherwise, in a few minutes, I think we're going to end this webinar. In the meantime, let me show you some other features of this app, of this web trader. Let's go back to our open positions and clear them all. And we're back to where we started. You can leave limit orders for options by clicking the word limit. I can buy a call and put a take profit on a call option, just like I can on a spot trade. And this is kind of an advanced course. If you go to the AvaOptions YouTube channel, you can see some videos explaining how this all works. But we're putting in a limit order on the option price. So the option price today is on this orange line. At expiration, the option price you can see is based on the expiration. Today, this option has some value because there's time value, but as time goes by, if you want to get 6 pips back for selling this option, spot's going to have to be higher. So if I move my horizon line, you're going to see something cool happen. This line, these lines are showing you where spot needs to be in order to get this option value back. In order to sell this option back for 6 pips, spot's got to be around 120.56 today, but at expiration, to get anything back, to get 6 pips for this option, this option has to be 6 pips in the money, which would be 121.36. Go to expiration, and you see this line is now moved up to 121.36. Kind of the advanced stuff, but very cool that you won't see in any other options trading platform. That's options trading. If I actually want to do this trade, I'll click to execute. So I'm buying an option with a take profit and a stop loss. I click execute. And it's going to show up in our open positions with the take profit and stop loss in blue. The trade is done. And there it is. We bought a call in 70,000, 121.30 strikes for a week. And we have a take profit and a stop loss. They're pending, so they're in blue because they're cool, right? They're not hot. So they haven't executed yet. If you want to cancel a limit order, just choose it and execute to close that, to cancel that order. And it will disappear just like that. Pretty cool. And one other thing to show you over on the right side, if you click the I button on the right side of the page, you can see charts of implied volatility. Where's implied volatility today in blue? Where was it a week ago in green and a month ago in red? You can choose your expiration date and you can see how implied volatilities have changed over the last month for different strikes and different assets. That's all we've got time for today. Thanks again, everyone, for joining us. This is being recorded, and at some point tomorrow, you'll be able to see it on the in the AvaOptions YouTube channel. Thanks for joining us. Bye.